There's much more algorithmic and there's more programmatic ways of looking at portfolios, but that's the analysis. In the end, it takes a human with judgment and some experience and thinking about how the world works and how actually asset classes behave in different environments to actually put it all together.
Hello, ladies and gentlemen. It's a great pleasure for me to be hosting the PWM Tea Break video with a special guest all the way from New York City, Alicia Levine, who is Head of Investment Strategy at BNY Wealth. Welcome to the studios, Alicia.
Thanks, Yuri. I have chosen a double shot cappuccino because it is early for me.
We had a guest on last week who loves drinking tea and said, you can't drink tea in New York. If you live in New York, you've got to drink coffee, and you look really out of place on the trading floor with a herbal tea. Is that still the case?
That's still the case. I mean, people are trying to be healthy and do longevity, but it's very hard to start the day without a double or triple shot of some really strong Italian coffee.
I recently did an interview with a lady from Citi, the head of wealth structuring, Oluolu Aganga, and she was saying, look, there's a lot more women, there's a lot more nerdish types working in the investments, because we were talking about structuring portfolios, and she said there's all this mathematical modeling now.
I'd say it is true. There's much more algorithmic and there's more programmatic ways of looking at portfolios, but that's the analysis. In the end, it takes a human with judgment and some experience and thinking about how the world works and how actually asset classes behave in different environments to actually put it all together. But we definitely use some sort of mathematical analysis as, I'd say, a wrapper to think about our risk tolerance.
So are the clients, are they getting very worried now about what's going on in the Middle East with the energy crisis, or were they perhaps more worried on the Great Liberation Day with the tariff tantrums?
In 2025, starting in November, I started having a series of very panicked conversations with our clients about threats of tariffs. And particularly after the Great Liberation Day, markets sold off about 12% in 2 days, which is massive and actually historic. And our clients were very concerned about what to do with their portfolios. Should they get out of the market? Is it too late to get out of the market? I had those conversations not just daily, but all day long. What's fascinating is that when the bombs started dropping on Iran, on February 28th, I've had almost no conversations about should we get out of the market. The conversation was more around when's a good time to buy because this will be over soon. And so that perhaps is showing you a different risk tolerance just 1 year after we had a sell-off of almost 20% and a fast V-shaped recovery. Investors have, short memories, but remember that. And so it's just a very different world. I'd say now, 3 months in, we may be having different conversations as the Straits of Hormuz remain closed.
It's very interesting that you were talking earlier, Alicia, about the human angle and about the importance of the humans' work in investment management, because we've had some great questions from our readers. A bit of a provocative question from Malik Sawa, and that's what you expect from a fellow New Yorker, because he works for the Global Leader Group in Manhattan, and he's asking, is it true that dumb humans are being overtaken by artificial intelligence in wealth management?
Artificial intelligence is just an extension of quant models, which is just an extension of thinking about how different asset classes perform in different environments. I don't think it's that unique. What is unique, I'd say, is if I plugged in to a model, tell me the effect of 20% tariffs on trading partners in a free trade regime, supposedly, tell me the effect on the U.S. economy, it would tell you stagflation, get out of the market, you're going to have very high inflation, you're going to have negative growth, and go to cash. Okay, that's what your AI would have told you. Guess what? It did not happen. And all last year, we had tariff rates of about 12%. We started the year at about 2%. Much higher, and we did not get the stag, and we didn't get the inflation. So that's the first thing. That's a human making the judgment that it's not going to happen. Same thing here with the war in the Straits of Hormuz. Plug in what does a $125 oil mean for markets? What does it mean for your asset allocation? And you would have said the same. Stagflation, negative growth, much higher inflation. And in fact, what have we gotten? We've had an S&P that's up almost 20% and NASDAQ that's up almost 25% from the day the bombs dropped. So, you know, in the end, the models work off of historical analogies, but the economy is much different than the economics would tell you would be the effect. So I think dumb humans actually with instinct and can think forward are going to do a better job than the models.
So that's the message for Malik. We're not so dumb after all. And I had some great conversations on this theme with Jose Minea, your colleague at BNY. And Jose was saying, look, a lot of the asset management, the investments, they're becoming quite commoditized. And all the wealth managers, they need to differentiate themselves. And he was saying, well, one of the ways is through the tokenization and the investments in technology.
Our clients are very interested in digital assets when they're appreciating, and we stop having the conversation when they're depreciating. So that tells you something. Typically, same conversation about gold as well. You know, this is a trust relationship, and that's the most important thing. It is true that it's easy to invest now in many different ways, but the trust relationship and the advice and the sense of, okay, this is the right plan. I was thinking about it the wrong way, but my advisor is telling me something that's really quite interesting. That's what differentiates, not whether you buy, you know, you have 58% U.S. large cap or 62% U.S. large cap.
That's a really great point you made, Alicia, because we did a survey together with H advisors in Switzerland, and they were really looking at the identity and the brand of the different wealth managers, because they were saying, you know, what is the difference between them? And my colleague Alicia was speaking to several of them, and they were saying, look, you have to have a defined purpose as a wealth manager.
We have families with us now for 7 generations, and I work with them very closely. We give the advice and the planning, and also as a family, how do you keep the wealth together to last 3, 4, 5 generations, right? So we do education for younger generations, and we plan in a way that makes sense. I'd say that is our secret sauce, and that's why we've been able to do this for more than 240 years.
I haven't quite been covering your institution for 200 years, but quite a few years. And I remember 2007, it was quite a highlight for me, the merger between Bank of New York and the Mellon Financial Corporation. And us journos, we coined the phrase that the Boney M merger after the 70s and 80s Caribbean group Boney M. And they had big hits, Daddy Cool, The Rivers of Babylon, Ma Baker. If there's a song that you hum to yourself, Alicia, about the investment market today, which one would it be?
Okay, so the first one is probably Kate Bush, Running Up That Hill. Markets are resilient and extraordinary. I'm so privileged to be here in London speaking about that this week. And so Running Up That Hill, since I am in London, Bowie and Queen, Under Pressure. And actually, I remember one day popping in the AirPods and just listening to it at the highest volume because I was under such stress, and it really spoke to me. You know, we're under pressure. We're under pressure because you see the risks everywhere. The tails are fat, meaning left tail, terrible outcomes. Right tail could be spectacular. You're under pressure to make the right decision, and you're running up the hill.
We are certainly running up the hill, but you've been very much on song today in this interview. So thank you very much for joining us, Alicia.
My pleasure. Thank you for having me, Yuri.
And sadly, that's all we have time for until next week, when we will be taking lessons from the sporting world for the investment and wealth management community. So please stay tuned, have a browse around the articles and videos on our website, and I look forward to seeing you all next time for the PWM Tea Break.